Hello to everyone up connected and welcome to this 13th French Founder SaaS Club meeting. First of all, I hope all of you and everybody are fine and safe and doing what you can with the business in the current situation. A big thank you to Stefan and Patrick Campbell to share with us your insight. My name is Sacha Nickbaum. I'm part of French Founders team here in New York City. Just a few words about Zoom. I'm sure you're pretty, you know very well how to work this platform. You can ask your question on the Q&A box on the bottom of your screen. Your microphone and your webcam are closed, turn off for the moment. And if you want to, you can also raise hand it will be a pleasure for me to give you the mic. This event will be recorded and available on the SaaS Club French Founders platform and the application. So feel free to go to see the record after that. We are now, almost 40 people and it's growing. Thank you very much for both of you, and Stefan, over to you.
Yeah, welcome everybody. I hope you hear me well. It's exciting to be confined, I guess. So I hope you're all healthy. I hope you're all in good conditions for this first SaaS Club that we're holding not in person. Because usually we have great lunch, usually we have great food brought by the French Founder organization. And this time, I guess we're just home, but we have a super exciting topic. And I'm super thrilled to have Patrick, who joined me today. Patrick Campbell is from ProfitWell, and he will share with you a lot of thoughts on pricing. But I think that we have a lot going on right now, and that topic of pricing might not be like front and center with all the craziness that's going on, but you will see that there is actually a lot of news specifically related to pricing and what we can see today in what is happening in the world of SaaS, whether it's B2C SaaS and B2B SaaS. So first and foremost, welcome to this new edition of SaaS Club. We have a lot of success. I think it's the one that we have the most people because usually we're in person, 25, 30 people in person, and this time we had like 75 registrants on this webinar. So the topic is of course super exciting. So without no further ado, I would like to introduce our speaker today. You know that the spirit of SaaS Club is always to bring some real deep subject matter expert to the table. Someone who's based in the US, someone who is like, really a deep expert into a topic. And the topic today is around pricing of SaaS offerings, right? Mostly our focus is largely on B2B pricing, but Patrick has some great insight on the B2C side as well. So that's what we're gonna cover today. And I'm proud to say that I think Patrick is like the best expert in the US right now around the topic of pricing and pricing optimization for SaaS businesses, and you will understand why. His background is an economist. He's an economist and a mathematician, and he was doing algorithms to hunt down bad people at the NSA first. It's on their profit. It's on your LinkedIn, Patrick. So I'm not unveiling something crazy there.
Uh-oh, we're gonna have to talk later. No, I'm just kidding.
Oh, wait, the Zoom doesn't work anymore. What did we do? We just got disconnected there. And then he went to Google also to do value modeling before he built this amazing business in 2012, where they decided to focus solely on pricing and pricing optimization for SaaS businesses. And that company is called ProfitWell. And you started it on a shoestring, pretty much. You never took any money. You have a thriving business. It's 70 people plus. You will tell us more about the business. So not taking any capital and taking funding from your customers, I guess, is the most noble and exciting term there. So we want to cover a lot today. Patrick, what I would like to do to start is I would like you to say a few words just about yourself and about the business. Then the second piece I would like to go into is talk about what's going on today. Are you seeing things today, or do you and your tools have any insight of the craziness that's going on right now in the crisis we're going through? And then we'll take a step back and go into like the price optimization strategy. So how should we think about pricing, right? So I will let you take it from here. The floor is yours, and then I will jump in from time to time to just move to the next topics. Patrick, the floor is yours. Thanks a lot for joining us today.
Yeah, definitely appreciate that intro. So I think it's one of the best intros I've ever had when speaking. So I should bring you on the road with me here. But yeah, thank you all for having me. It's been kind of a fascinating couple of weeks, obviously, and I think that's an understatement. In kind of already a fascinating couple of years within the world of subscriptions and SaaS. And so I think the original topic that we were going to talk about was obviously monetization and pricing, and the goal, and I'm still going to do this today, is really giving you a framework for understanding and optimizing your monetization, and even amongst the current environment that we're in. But I think what we're also going to do, which was just alluded to, is we're kind of in this unique position where we are sitting on a ton of data. We have about 20%, depending on how you measure it, of the subscription and SaaS community using one or more of our products. And so there's a lot of data that we're able to kind of sift through. And basically last week when stuff started really hitting the fan, and the markets were already kind of all over the place, we started putting together essentially an index to understand in as real time as possible, like how this was affecting the B2B space, the B2C space, all in the world of subscriptions. And so we're going to share some of that data with you today. We published it for the first time yesterday, so you're getting it essentially in the first group that we're kind of rolling this out with. But to give you a little bit of context on like
Patrick,
where that all—
just a second, if you don't mind. You're saying something huge here. You say you're seeing 20% of the subscriptions. Just comment on that. What's the secret sauce that makes you see 20% of the subscription?
Yeah, exactly. I was just about to say that, actually. So background, you already got some personal background, but we have a product called ProfitWell Metrics. So this product, it plugs into your billing system. So it plugs into Zora, Stripe, Chargebee, Recurly, whatever you're using to basically process your payments and your subscriptions. And we give a ton of value with this, and it's a free product, which that doesn't mean it's bad. It's actually the best in the market, and we can measure that somewhat objectively, but obviously I'm a little biased. But we give you access to all of your MRR, all of your reporting around financial metrics, your cohorts, your churn. We enrich all of your data for free with Clearbit and full contacts. So you can segment by firmographics, location, all types of different things. And there's a larger reason why we give that away for free from a monetization perspective. The short end of the story is analytics is a very tough business to be in. But in addition to that, it makes our paid products better. In our paid products, we have a couple of them that basically focus on not only helping you reduce churn. So we have a product where we reduce basically delinquent churn or payment failures. We're really, really good at that, and we use the data that we're sitting on in order to make those algorithms work. And then we have a couple of other products, one of which that's really pertinent today is this product called Price Intelligently. And if you've heard that name before, that's what our company was called previously. Never change your name. It's the worst experience you can go through. Maybe not the worst experiences in the next couple of months, but it was not fun. And that product is a software product that's mixed with service to basically help companies with monetization. And what's kind of cool about it is because ProfitWell is free and it's good, we have, again, about 20% of the market. And that ranges from, as I like to say, Johnny and Jane startups, all the way up to Fortune 50 companies using that product. Typically, we say if you're under 100 million in revenue, it basically takes care of 90% of your financial reporting, if not 100%. So that's kind of where the context comes from. And that's where, this index came from that we were able to put together because, we're just sitting on the data.
Before you go there. So I have a SaaS business and I use a billing system, Zora, NetSuite or whatever that manage the billings. I can take your freemium product and I can hook it into that stream of data pretty much. And you're bringing that dashboard, that intelligence, the net attrition, et cetera, et cetera. You're going to do all those calculations based on that. My cohorts analysis, et cetera, right? So that's, I think that in its own, frankly, when we were preparing that, I didn't know you had that freemium product as well. I think that community that's connected here, there is just a lot of greatness in what you offer for free already. And something that I think everybody should have in some, form or shape. You turned into a product, right? Because everybody's calculating their own cohorts. We're all doing those exercises. And then we fight with VCs, by the way, because the way they do it is the same. right? I'm sure you've seen that over and over. So
Yeah.
I think that's a first key takeaway for the audience here is check out that free product, check out the insight that is providing, and let's have you share with us a little bit what you're seeing with all that data that's flowing through your system from all those subscriptions.
Yeah, totally. And it was, the big push for us was, there's a funny little anecdote. The reason we went from just the pricing software to this other software was we were helping a company that was about to IPO with their pricing. And this outside vendor, discovered that they were calculating MRR and churn completely incorrectly. So there was a CFO taking 2 other companies public. This was his third, and he was calculating what we would presume the most basic metrics incorrectly. And that's what started us kind of on the path. And, that's why we focus so much on accuracy. Accuracy is like the thing that's our differentiator versus some of our competitors, as well as obviously spreadsheets and things like that. We're even helping folks like Zora and Stripe, be more accurate with their own analytics. And so, it's been a labor of love, and thankfully the product's good. So it's, taken off, which is great. But in terms of the index, so I want to kind of explain to the founders in the room, like what we did. And frankly, putting this together was a bit of a selfish, endeavor because, all of you on the call, you know what's happening in the market. You're getting advice from, VCs who are telling you like, oh, expect revenue to go to 0 for 18 months. And then you're getting advice that, oh, this is going to be done in 3 months. Don't worry about it. Right. And it's really hard as a founder to make decisions. And so couple of weeks or 10 days ago or so, basically we were like, well, us as a B2B SaaS company, we can serve, ourselves and the market by like releasing some data to help us make decisions on like, how bad is it? Is it, going to last forever? Is it not? And we can't answer all of those questions with a definitive, 100% certainty, but we can at least give some data to kind of help. And so just to give you a really high level of what we did. So we took basically 15,000 subscription companies. So not our entire base, because we cleaned it of outliers. We cleaned it of, basically companies that didn't fit necessarily the model for a whole host of reasons. And then we broke this down into an overall growth index. So to put that more simply, we basically took a batch of these thousands of companies, and then we looked at their MRR since January 1st, 2019. So it's kind of like a stock index. We put them all together. We obviously can't show you the exact dollar amounts, but we can show you an index of, is it going up? Is it going down? When is it going up? When is it going down? And then in addition to that, we broke down not just the MRR, but what does new revenue look like? What does lost revenue look like? Churn? And then what does the aggregate daily growth look like? And so we basically want to track this on a daily basis. And we've been tracking it now for about 10 days just to understand. And so this was updated literally right before the webinar here for using yesterday's data.
That's some sort of a health metric of the SaaS businesses right now. Would it be fair to say it's like my SaaS weather? My SaaS, my SaaS health metric.
Yeah, exactly. So this is, it's more like, what does the market look like, and what's the health of the market? What's the health of the segments of the market, right? And that's kind of what we wanted to do was, obviously if this is really bad, we want to make decisions. We want you to make decisions. If it's kind of okay, maybe you can wait and see. And obviously if it's good, then, we can kind of ignore the bad stuff that's happening. As we're going to find though, the health of subscriptions as a whole, and you're going to see this is a little bit different for B2B, is not so great. And so what I mean by that is the data you're looking at here. And again, this is 15,000 companies put together, and we're looking at their aggregate MRR growth since January 1st, 2019. And what you'll notice is that you're seeing like it's all up and to the right overall, which is great. But as we look kind of at recent days, all of a sudden you're starting to see this kind of dampening. And if we zoom in, so this is basically the graph since January 1st, 2020, everything was going great. And then all of a sudden, COVID actually started affecting things, and you're seeing like this dampening and this flattening and almost a bit of contraction here. Now, what's kind of interesting and pretty important is that this is mostly being driven by B2C right now. So
and Patrick, just to make sure everybody's following us, you do that for a living, right? And this is like pretty much the additional net new subscriptions plus the upsells minus the cross sells, minus the down sells, or minus the attrition. Is that fair to say? It's your net growth.
Yeah. So this is actually the MRR, growth.
Yeah.
So
Yeah.
this is exactly right. So it's not, I'm going to break it down in a second, but this is basically like the overall index of what's happening in the growth of MRR every single day, essentially,
Okay. And
of
this
this group of
represents
companies.
probably hundreds of millions of MRR that you see going through your systems, right? What's the rough number? Is it like 100, 200, 300 million?
I have to be really careful in answering that question, but I can tell you that we track just over $10 billion in ARR. So annual recurring revenue.
Huge. It's huge. So it's roughly an aggregate on like almost $1 billion. The rough order of magnitude is like, we're not talking about like analyzing 100 million here. We're talking about like something that's like an order of magnitude bigger that has a real meaning, meaningful information. Okay. Sounds great.
Yep, exactly. And that's why, looking at it overall is interesting, but obviously we want to break it down and to kind of maybe calm some reactions that people are already having. This is mainly, at least right now, being driven by B2C. So these companies that are serving consumers, because this is what their overall since January 2019 looks like. So, consumer businesses, they flatten a little bit, obviously around the holidays here. And then all of a sudden COVID comes and it's basically the sharpest cliff like we've ever seen with a lot of this type of data. And this is intuitive. It sucks, but it's intuitive, right? Because basically anything involving going outside right now has, gone down. Now, there's definitely consumer businesses that are winning, and I'm not going to go too deep into this presentation on that just because it's a B2B audience, but it is something in aggregate. This market's getting hit pretty hard. Now, to think about B2B though, which is kind of where most of us are here, B2B hasn't been hit quite yet. And so what you're looking at here, this is again, since January 1st, 2019, all the way till yesterday, essentially, you have this little lull for Christmas, and then we're kind of moving up, since then. And when we look at the zoomed in, so this is January 1st, 2020 till today or yesterday, you're starting to see it's very faint, and it's a little bit hard to see in the graph. I can see it a little bit easier when I look at the actual aggregate or the raw data. You're starting to see a little bit of flattening. And I'm going to go deeper now in B2B, but the kind of TLDR, like the takeaway that I would take away from this with B2B is, we haven't been hit quite yet. Some of us have been, don't get me wrong, especially if you're serving like, restaurants, or you're serving an SMB of some sort that's, something involving going outside. But the rest of us, we're kind of in what I would characterize a little bit of a calm before the storm. And as an economist, we only make predictions in the past. So I'm going to be very cautious about like what's going to happen here and just be more like, hey, this is where the data is. We're going to update it daily. But it is one of those things where I'm, at least as a founder, worried about the second order effects of what's happening in the overall market, meaning, it's starting with B2C and then it might come to B2B very quickly, depending on how the market goes. And the reason I have that view is because when we break down the new revenue on a daily basis and the lost revenue on a daily basis, we're starting to see a little bit of a more specific story. And so what I mean by that is that B2B, the new has slowed a little bit, and it's actually recovered a little bit in the past couple of days. But the loss, aka the churn and downgrades, have actually gained, meaning they've gone up pretty considerably. And what you're looking at here, I just want to make sure I explain this. These dotted lines. So first off, on the top, this is new revenue. So new revenue is the new sales and upgrades, and the bottom line, this is lost revenue. So churn and downgrades, and this dotted line here is essentially the last 6 months of 2019, the average amount of new revenue or the average amount of lost revenue. And so what you'll notice is that basically for new revenue, the first of every month, you have this little bump because a lot of people start contracts or end contracts on the first of the month. And then we're kind of tracking just above that line. And if I zoom in, it's a little more obvious that it's above that line. And you can see here, there's a little bit of like actual increase. There's a little bit of a decrease, and now there's a bit of an increase that's happening. Now that's really great, right? But the problem comes, as anyone here knows, you got to not only gain revenue, you got to keep the revenue you have. It really comes into play at the staunchness of this B2B curve for lost revenue. So what's happened is, if we look at, yes, we are gaining some new revenue, which is very promising, but we're losing a lot of revenue, is that basically when we look at the net, so this is daily growth essentially for B2B, what we're starting to see is that we were growing at the beginning of the year above last year, which is great. That's compounding SaaS. That's just kind of how it works, right? But all of a sudden, we're now contracting below that line. And this is an aggregate. Some of you are going to be doing great. Some of you are going to be even worse. But this is one of those things where when I look at this as a founder, I go, all right, so everyone kind of freaked out for 2 weeks. Does that mean they're going to continue freaking out the next 2 weeks? Or is this something where, there's going to be a continued trend, right? And I know that's not necessarily like comforting. It's not like, hey, Patrick tells me I have to do X, but it's one of those things that based on your current position as a B2B founder, you kind of have to protect either your downside or you have to, basically protect your upside, which is one of those things that's really hard to do in this type of a market. So just to kind of summarize, and then I'm going to pause in case, Stephanie, you have any questions or want me to go deeper on anything. No one knows anything. That's the big thing. But we are updating this daily, and the trend does seem to be continuing for B2B SaaS. We're literally updating it daily. We're going to start publishing it in one of our pieces of content every single day, so you can get it, and I can send you basically how to get on that list. If you have anything that touches consumers, meaning like you're, a gym software or a restaurant software, you probably should either just one, batten down the hatches to try to get, 12 to 18 months of runway, 12 if you want to be kind of liberal, 18 if you're conservative, and or pivot a bit to an online model that helps your customers with an online model. We've seen this with a couple of folks where some gym pieces of software, they have now basically created some software that allows their gyms to provide an online experience to their users. And the same thing with restaurants for deliveries and things like that. And then finally, and this is more of a personal thing I'm saying because I'm doing this, just get a framework for making cuts. Maybe you're not going to execute on that framework. And hopefully most of you have already thought through a lot of this already. But I'm just kind of reminding every founder group that I talk to, because we're either in a blip and we're in a new normal, and so revenue will kind of stabilize and churn will kind of stabilize, or we're in this calm that is going to get a little bit worse, which I know doesn't give you a ton of direction, but hopefully gives you at least some direction to kind of think through. But I'll pause there before we.
Yeah, that's awesome, and of course, it wasn't the core of what we wanted to originally address in this SaaS Club, but it's definitely very relevant because it allows us to assess, hey, is the flywheel overall across a huge number of companies that you've compiled, those 15,000 companies, is that flywheel that we love, right? SaaS is all about taking that flywheel and making it fly faster
100%.
With the net new and the upsell minus the downsells and the attrition. That flywheel right now, you're saying, hey, it's slowing down, right? It's slowing down, and we're in the early innings of that, of course, of that crisis. So the question is, hey, how much is that flywheel gonna slow down, right? And we should keep an eye on that and use your index that you're going to publish. That's a great PR bonanza for you guys, by the way, as a company. We'll make sure that resonates and shared with the community here how to access those dashboards. But it's going to be exciting to see over the next few weeks and months, where do we stand and how can I benchmark my business versus the average B2B business. These are things that could be used in conversations with your VCs, also talking to the audience. We know there's a number of panicked VCs around the table. They wonder if your business is in better shape or worse shape than the other businesses. Use Patrick's index in the upcoming weeks and months to benchmark you against. So let's talk about monetization, right? And of course, this is a more long-term topic. And as you were saying earlier to me, is sometimes it's a topic which just kick the can down the road, right? We're like, hey, oh my God, price monetization. I need to involve finance. I need to invoice my salespeople. I need to invoice product marketing. I need to talk about the VCs. We talk about it with the VCs, and it's just that can, and it's gonna irritate my customers. We shouldn't do this. So we always have 100 reasons for kicking that can down the road. But the reality is that there's a lot of value that we leave on the table here. So walk us through your framework about how can we optimize monetization of those products and services that we deliver in SaaS.
Yeah, 100%. And the one comment I'll say just on the first thing you said is, when you hook up to ProfitWell, and we can find a way to get this to you, depending, because our thing is, we serve this community obviously, and like if the community doesn't do well, we don't do well, right? And so that's why like we're trying to get this data out there. We also have a benchmarks product that's built into ProfitWell, so you can actually play around and look at like what's my churn versus similar ARPUs, similar similar size companies, similar verticals, and that's been helping a lot of people with those conversations with VCs because in the it's always a weird. And weird, I think, is the right word, negotiation of like, and you can say like, hey, our churn like is really, really good. Actually, that's a reason you should invest in us, because I think that the base unit economics, I was on a panel yesterday with Mark Roberge, the former CRO of HubSpot. And he was saying like, a lot of VCs, and now he's a VC. It's like, you're going to get a little bit more forgiveness on top line revenue growth in the next 9 months, meaning it's not going to be as important. Like it doesn't need to be 100%, doesn't even need to be 50%. Where people are going to be a lot more stringent is like what's going on with your base unit economics, your ARPU, your churn, these types of things. And so you can take a look at that inside ProfitWell. But in addition to that, to kind of transition also to pricing, it's like monetization. What a lot of us don't realize is that no matter what your business is, and everyone here is B2B, but you could be a nonprofit, you could be a retail business. Everything you're doing is driving someone to a point of conversion or justifying the price or the product that you're offering them. And so what that means is that when we set the stage here for what we're trying to do with monetization, what we can realize is that your price is basically the exchange rate on the value that you're providing. And what I mean by that is because we don't trade goats for wheat anymore, we're not in a barter economy anymore, and hopefully we never return to one. We're ascribing this number or this type of exchange on this value that we've created. And I think a lot of us, when we start to kind of conceptualize your monetization in that light, we start to realize that there's a lot more to our monetization than just the price point, or just ending your price in 9 versus ending it in 0, or just putting the most expensive tier on the left side of the page versus the right, which is all the crazy questions we get, which aren't really core to your monetization. But what we'll also realize here is that there's so many other levers that you have when you're driving those customers to a point of conversion or justifying the price of the product. First off, there's who we sell to. The advice that we've heard most is you should, be throwing out your conception of who your ideal customer is right now, mainly because you should be rethinking like who you should be targeting, how you should be targeting them. Because, if you were targeting gyms, or you were targeting, some folks that sell to gyms, that should not be a customer anymore. In addition to that, like really rethinking your product. But basically we can make adjustments to the product when it comes to monetization. We can add add-ons. Add-ons are one of the most underutilized monetization levers in B2B SaaS right now. We're so focused on putting more features into the product. We don't realize that a lot of those features, they're not used by everyone. And therefore they could be pulled out and actually monetized and not only increase ARPU, but also increase your retention. And then ultimately the other piece is obviously your price, which not only acts as an impact on your conversion, but also impacts essentially the perception of your product, right? For us with our free product, our pricing page, we've had to put a big enterprise plan next to it. So when the Fortune 500 companies come in, they realize, oh, we're in the enterprise plan, right? And it's not just this free tool that I'm not going to trust, right? And so there's a perception that happens with your price as well. But the big thing to give you like a number, to give you a KPI is it really comes down to anything that you're doing that impacts your ARPU, your average revenue per user. And you may be measuring this as ACV or ARPA, but it's really just the amount of revenue that you're getting per user. Any individual change that you make that impacts that number, that's a monetization lever that you're pulling. And some of these are really, really easy. So if you're using a value metric, meaning you're charging per user, per 100 visits, per 1,000 views, you can adjust that, meaning, okay, so this tier had 1,000 views, now it's only going to have 750. That's a pretty easy change to make. Price increases, even in this market right now, it's one of those things that like, it's a pretty easy thing to do. You're probably not going to want to do it. You're probably going to be a little skittish about it. And then add-ons, which I kind of already talked about. And then on the harder side, and there's a bunch more than these, but I just want to give you some examples. It's really hard to change your customer proportion because even if you're a 100-person company, if you think about how many things you have to do to get everyone on board, to market, to sell to retain, to convert all these different types of customers. But there's a lot of folks who go up market, go down market, and then feature differentiation, which 10 years ago was actually one of the easiest things to do to affect pricing. It's actually really, really hard now, and I'll talk about that or why in a second. But the big thing here is that when it comes to monetization,
when you say
ARPU,
feature, Patrick, when you say feature differentiation, just
sure.
elaborate on that. Like you make some features available in a certain bundle.
Yep, exactly.
And a more advanced feature available in the higher bundle.
Yep, exactly. So we would take, we used to be able to like, oh, we have this new feature. Oh, let's put it in tier 3, right? Because we're going to get people to upgrade. And intuitively, that would cause people to upgrade. But now, as we're about to see, feature differentiation is harder because it's harder to identify that feature that'll cause people to upgrade because there's so much software in the world right now. And I'll explain that in a little bit. But to just kind of close this point out, the big thing is that a lot of you aren't focused on your ARPU rising. And if you really look at your ARPU, and you can plug into ProfitWell or look at your spreadsheets right now, your ARPU is probably relatively flat over the past couple of years because you haven't done a lot to basically, go after that particular number. And to give you a little bit of perspective here, the reason is because the average amount of time it takes a subscription company, so this is subscriptions, but SaaS is basically the same thing. The average amount of time it takes them to adjust pricing, and just to be super clear, this is not changing the price necessarily. This is adding plans, subtracting plans, adding add-ons, doing a new discount strategy, all of the different changes, not just the actual number. It takes about 3 years on average for companies to do this. And in fairness, the average is coming down, which is great, but it's not coming down very quickly. And so it's one of those things that what we've noticed is that most people just don't think about this growth lever. And this was referred to before because, if I gave everyone in this room, you're all founders and executives, if I gave you a problem, an engineering problem, a product problem, a sales problem, an operations problem, doesn't really matter what that problem is. But if I gave you that problem, I'd almost, you'd go, I don't really know anything about this, but I'm going to go figure it out because I'm a founder, I'm an executive. You probably wouldn't say that out loud, but that's like the mindset, right? Now, if I give you a pricing problem, all of a sudden you go, as was alluded to before, I don't know, it's going to aggravate people. And I got to talk to Joe in sales and, John in customer success. And I don't know, we'll just kick it down the road, right? And what that
there
means
is also no clear owner, right? In all fairness,
yeah,
there is not
totally.
the chief pricing officer in the business. I think we haven't had that muscle. That muscle of optimizing
100%.
pricing is not developed in the SaaS businesses, and that's why we're here. Because when it's a sales problem, we're going to call the VP of sales, say, "Hey, can you solve that problem with me?" And here, the pricing problem spans across multiple departments in your organization. It makes it just tougher to address or easier to kick the can down the road, pretty much.
Yeah. Well, and I think what's kind of interesting about this is just to give you some data here. We have seen that more pricing changes does correlate with higher ARPU. Now, this is correlation, but it's also intuitive. Obviously, if you focus on a metric or if you focus on doing something, you're going to affect that metric, hopefully in the right direction. But some data you're seeing here is this top line is essentially all of the companies that are changing prices every quarter. Again, that does not mean they're raising prices every quarter. That's a big misconception when I show these slides. The next line down here, they're changing pricing in some way every 6 months, every year. And then the bottom line is basically every 3 years, right? And this is the growth of ARPU or ARPA or ACV, depending on how you're measuring it over time. And I think there's part of this is exactly like you were saying, is that there isn't a real owner, and we're going to talk about that in a second. But I think the other part of it is that we don't really understand, why this is so important right now. And the main reason it's so important right now, and this is kind of where I scare you if I haven't scared you already, is that today in 2020, we've lost a lot of our power as businesses. I don't know the ages of everyone here, and I don't know how long you've necessarily been in the software game, but it used to be the biggest barrier to building a company was the technological barrier. Hey, I have to host I have to have these servers here. I have a server rack room. I have a person or persons who's handling that. Just to start a company, it was really, really complicated. Even if you just wanted a website. Today, if all of us wanted to scrap our current companies and spin up, a new company, we could have the server up and running, the website, we could start driving traffic to the website. The product probably wouldn't be that great. Product's always going to be hard to build, but it's one of those things that the barrier of entry has gone away. And in addition to that, every single quarter from about 2001 to, basically 2015, or every quarter, at least every year, I should say, we were getting a brand new major marketing channel. I don't know if anyone remembers Google AdWords for a penny a click, then Google Remarketing, then the Google Display Network, then Yahoo Display Network, all these different things. It was amazing to build a company basically between like 2001 and 2007, and then, really a little bit kind of post 2008. But those were kind of the golden years or the gilded age of subscriptions and SaaS. But now what we found, because there's so many more companies out there, because there's all kinds of stuff happening, customer acquisition cost is up about 70%. In both B2B and in B2C. And this isn't survey data. This is actual CAC data from about 750 companies. And basically that customer that costs you, let's say $100 now, about 6 years ago, they're not costing you about $170. In addition to that, on the other side, like product value is down. So we are pricing software. We measure willingness to pay and feature value and things like that. And we basically, across the years have been measuring that value for different types of software. And what we found is that, things like a Salesforce integration 6-7 years ago that you're able to sell for an additional $1,000 a month on top of your existing product, that product's now just expected, right? And there's some markets that can still sell Salesforce integrations for more cash, but this is about 900,000 data points on just willingness to pay. Things like analytics, the traditional add-ons that we were selling, all of a sudden they're now just expected. And the reason for this is because, software is kind of, it's lost a bit of its magic. You used to be able to put a, login screen on a database and you were looked at as like a god. Yeah. Now, if it doesn't have good design, doesn't have good support, doesn't have good, exactly what I need, I'm not even going to talk to you, right? And the kind of
you're saying here that the software is eating up the world, right? And software is now available in every industry, and just everything is software. Everything is turning into software, cars and everything. So that the consumer has been educated, the consumers and the businesses have been educated in consuming much more software. The price for building out software businesses is becoming commoditized because you can mash up services. AWS helps you spin up a lot of stuff with instantly. And when I built my first businesses in 91, I mean, as you said, we were paying hard to buy a Sun microsystem server. And it was painful to pay for that server and the maintenance and everything. Now you're just put your credit card in and consume as many cycles as you want on AWS. So that commoditization plus that education of the buyers of software has driven down the ability to extract value out of those services and features.
Yeah. I think it's also, there's been a huge conception shift with consumers, I think, as you're kind of alluding to as well. And, we've seen this in, this is a bold headline. Obviously you have some customers that are grateful, but in things like NPS scores, right? Where they're actually down. So this is the actual scores. It's about 1,800 companies here. It's not like we asked them survey data. We actually went and got the raw data. And basically over time, NPSs have gone down, and I don't think anyone's going to stand up and say software is worse today than it was 10 years ago, right? And so it's one of those things that the market's just changed so dramatically, and I think that a lot of us are marketing as if it's 2005, right? And it's we're getting a lot of advice, and yes, there are some verticals where you should go and raise as much money as possible and buy the market. There are some verticals that acquisition is all you should be focused on. And you're probably always going to be spending half of your expenses and your time on acquiring customers. That's the fact of life. But our response, as I kind of already alluded to, is let's just keep spending. Let's keep going. Let's keep kind of on this concept of cheap acquisition. But what we found is that you need to be good right now at acquisition just to survive at this point, not even to thrive. And what I mean by that is, we broke down the three main growth levers in the flywheel of a SaaS business. So acquiring customers, monetizing them, and retaining them. Those are the three big levers that you have. And we basically wanted to figure out, if we adjusted those by the same relative amount, what would be the impact on revenue? So if we increase leads, conversion volume by about 1%, what would be the impact on revenue? If we increase ARPU by 1%, what would be the impact on revenue? And if we increased retention or lower churn by 1%, what would be the impact on revenue? And what we found is that if you increase acquisition basically by about 1%, your net new leads, you're going to see about a 2 to 3% boost in your overall revenue. And this is for about 750 companies. Now, if you increase your ARPU by about 1% or your retention by 1%, you're actually seeing about 4 to 8x impact on your overall revenue. Now, what's interesting about this is that the 1% gains for monetization and retention are a heck of a lot harder than the 1% gains in acquisition. And you're still going to spend 50% of your time and money on acquisition. But I think that the thing that I'm trying to get across here is you should be spending a little bit more time, if not a moderate amount more time than you are right now on your monetization and retention, especially in today's world. Because your monetization and retention right now, you have a heck of a lot more control over, at least at this point, than acquisition. Because acquisition, today, not only today from a COVID-19 perspective, but today as in 2019, 2020, you have a much more density in the market, or today as in COVID-19, you have a lot more uncertainty in the market. And so it's one of those things where like these two levers are really, really important long-term, but they're also really, really important right now. And I know that like, this makes everyone feel terrible. Everything I've said.
I think that's been always the case. I think it's just exacerbated right now. We've always said, and there's so many old studies on that in business school where you said, hey, retaining a customer and developing a customer is 5 times less expensive than acquiring a new one, I think is what's roughly the ratio. So you're just saying, proving it by the numbers here. That's a muscle. The pricing optimization muscle is a muscle you need to develop inside a business, inside a SaaS business. It becomes a critical factor of success to have that muscle developed.
Yeah, and we're seeing it in growth data as well. As I didn't include this data because there's a lot here already, but basically those companies where the only lever that's improving is their acquisition numbers and the other 2 types of numbers are kind of stagnant or getting worse, versus those companies that not necessarily even at the same rate, but all 3 levers are improving, and this should feel intuitive. Those folks who have that balanced growth, like they're growing at much higher clip. And it's just because like, again, you used to be able to hide your lack of discipline by spending money or spending time. And now just in the market, let alone in the COVID-19 situation, you have to be more disciplined. You have to be a better, executive, a better founder. But I want to make sure we're going to get to questions in a couple minutes here, but I wanted to not just be a Debbie Downer. And I wanted to give everyone a couple of things to kind of latch onto. And so I'm going to go through these not so quickly, but like, a little bit faster than I normally would. And then if something didn't make sense, obviously like let's circle back in the Q&A. But I broke this into phases because a lot of you are a little bit more advanced in terms of your trajectory, meaning you're past, the early days of just trying to get your first customer. And so I wanted to make sure that I kind of broke this down in all right, these are the 2 things that you absolutely should do. You should do these. You should have done these already in your early stage, but you probably haven't done them. So you should make sure you do them now. And then there's a bunch of like other things that we can kind of talk through. But the first one is, and this is the thing that if you don't do anything else, and if everything else is terrible, or not quite terrible, if everything else is not great, but this is the one thing you got right, you typically are okay. And this is getting your value metric right. And as I already mentioned, your value metric is how you charge. It's basically, do you charge per 100 users? Do you charge per 1,000 visits? Like, how do you actually charge? And the big thing here, and most folks in the call probably aren't doing this anymore, but you shouldn't be doing just straight feature differentiation for your pricing anymore. The world has changed dramatically. Not only can we measure what people are actually using, but we can price based on it, which is great. But to give you some examples, this is Intercom. So it's the messaging product. So if you look in your bottom right of most websites, you'll see Intercom or one of their competitors. And they charge essentially based on the number of people, so leads that use Intercom or customers that use Intercom in basically a monthly period. So if you have 1,000 people who use it, your price is X. If you have 100,000 people, your price is X plus Y, essentially. Now, one of their competitors, Drift, they basically have per user based pricing. So how many seats do you need? And I wanted to show this differentiation because you can have competitors with very different pricing models. And Drift is doing this because they're mainly targeting salespeople, Whereas intercom is more messaging across the organization. So marketing, sales, product, et cetera. But the big thing is when you look at value metrics, the beauty of them is as people consume more, basically they start to basically pay you more. And as they consume less, they start paying you less, which yeah, isn't great, but you have these entry points for all types of different customers. And if you can price as close to performance as possible. So with Retain, our retention product, we price completely based on performance. Now, the reason we're able to do that is because we can actually measure the revenue we're recovering for you. Not everyone has that luxury. And so Drift would love to measure how much money they bring you, but they can't necessarily do that. They can't get everyone to agree with that. So they take one step back and they go, well, what's a proxy for that? Well, a proxy could be per users, per number of people that go through it, and they've chosen the per user model. Now, value metrics, just to give you some perspective here, growth is so much better with value metrics because you have that upgrade revenue and that contraction revenue basically built in to the model. So the light green here are those companies and their growth with value metrics for about 3,500 companies. The dark green is basically those who are strictly using feature differentiation. And the reason for this is churn is really, really good. So what you're looking at here is revenue, monthly revenue churn, gross churn. On the far left here is the churn rates of basically those who are using feature differentiation. And on the right here, you're looking at basically those folks who are using value metrics in some particular way. And then expansion revenue, because it's baked into how you price, is really, really good as well. You're looking at basically the same categories, just obviously expansion revenue is higher for those folks using value metrics on the far right here versus those using feature differentiation on the left. And to close that out, I think if you get the value metric right and everything else like somewhat wrong, you'll be pretty good. Now, the last couple of things before we kind of open it up for questions. One, and I know this sounds super pedantic, but you got to determine who your market is. And, you know, especially right now, like reconsidering who your market is. And the reason for this, the reason I put this out here is because like Grandpa HubSpot, Grandma Marketo, they've been talking about buyer personas forever, right? And I think that a lot of us, like, we were like, okay, that's cute. Like, give it a cute name and give it a little avatar and like get into a room and argue about like what they care about and stuff. That's not exactly what I'm talking about. What I'm talking about is like, you should quantifiably understand as much as you can who you're targeting. And the reason for this is intuitive because you're driving that point to a person to a point of conversion. And if you don't know who that person is, you don't know what they care about, you don't know their willingness to pay, you don't know the unit economics of that user, it's really, really hard to build that flywheel. And so when we built ProfitWell, when we were going from Price Intelligently to building ProfitWell, we went into a room and we knew this data wasn't necessarily going to be accurate. But instead of just like the cute avatars and names like we do have here, we went down and we said, what do we think they're going to value? What do we think this user is going to be, you know, not valuing? What do we think the lifetime value of the user is? What do we think the CAC is? What do we think the willingness to pay? And in reality, these were much, much bigger documents than just this slide. But it was one of those things where we put that out there because if we thought that they weren't willing to pay a lot or the lifetime value was going to be terrible or something, we would have stopped building or we would have found a different market or something else, right? Now, a lot of you are more advanced than just like day one, but you probably haven't done an exercise like this in a good level of detail. And what we ended up doing is once we had these hypotheses, we then went and started testing those hypotheses using, you know, kind of a bastardized version of the scientific method, which we've written a book on and everything, so I can send it to you, but this is kind of the pricing process. And we went out, we collected a bunch of data, we cleaned the data, we quantified these buyer personas, meaning we basically went and looked at, you know, are we right with our assumptions? And then that helped us influence our pricing strategy. Because what we found is that this is what our buyers actually looked like, at least for the version 1 of ProfitWell. And as you can see here, if it's a quick look, like Startup Steve, we were going to break even on, and Mid-Enterprise Meredith, we were going to basically be underwater on. And so rather than building for 2 years and discovering this in 2 years, we were able to basically save ourselves like 18 to 24 months by discovering this in the first 3 months of building the product. And that's what led us to going for free. And that's also what led us to, you know, basically making sure that we were looking for monetization at some point, not just based on the actual like analytics product that we were going to be selling. And to kind of, I know this is like a very high level point and we can go deeper on it, but I guarantee you, even in the midst of COVID-19, there is a segment of your market that you as a founder got really, really excited about. And you're like, this is the market, this is the amazing thing. And in reality, it's like terrible for your business. We see this all the time. I got 7 to 8 anecdotes that I could give you of companies that spent $100 million acquiring a type of customer, then realizing that that customer was just terrible from a unit economic perspective. And then all of a sudden they're like underwater in terms of their capitalization because they've wasted so much time and so much money. So just really, really make sure you understand those buyers, especially when you're going through things like we're going through now.
Yeah, so your point is especially true right now because there's verticals that go strictly to zero, and there's all the verticals that are booming, right? Everything that's remote work, remote interactions, fitness at home, etc., as opposed to the other verticals going to virtually zero revenue. So doing that ICP, that ideal customer profile, and understanding what are the value driver for each of those segments, I think this is really something new because a lot of businesses are going through that ICP process, but just going one click further down and unpacking that all the way down to what is that person, that persona valuing, and how can I extract more value in every interaction I have with that person for my product or service. So that's a great takeaway. So keep going. We have a few questions coming, but let's keep going for a few more minutes there.
Yeah, I think I'm going to go through a couple of rapid fire ones, and then we can go to questions. So give me like 3 minutes. So first up, price localization. I think everyone here is either not a US based or not a US founder. So you have a lot of experience, obviously, with European pricing and things like that. What I mean by this is make sure that if you have even a small minority of customers in a different region, that you're pricing them differently. And the reason for that is, or at the very least, showing them the currency symbol of their region that they're buying in. Because what we found is basically localization correlates with growth. And this is ARPU growth. So on the far left here, this is no localization. So it's kind of like the control. Cosmetic localization, this is just the prices are the same. And basically controlling for exchange rates and things like that, but the currency symbol has been updated. And then up here is where the prices are actually different. So meaning you're charging the equivalent of $150 in the UK and $100 in the US. And to give you some evidence for this, it's about 1.5 million data points on willingness to pay relative to the United States. So if you asked me like, hey, we have customers in X region, how should I price them relative to my US price without collecting data, which you should always collect some data. But I would tell you, UK, Western Europe, about 20% more than the US. And this controls for VAT and currency exchange rates, just to be super clear. So it is a one-to-one comparison. The Nordics, about 30% more. And then Southeast Asia, obviously much, much less. It's going to change depending on the product that you're selling to, but it's one of those things where localization is super key. And then another bigger thing to kind of think of is like a pricing committee. So as was mentioned, like there isn't like a chief pricing officer, and I would argue there probably shouldn't be at most companies, just because it's not, it's not something that you're necessarily going to have like an executive level role on, because your executives should be helping make the decision. Now, what I mean by that is basically what you should have is some sort of a process where you're able to make changes to your pricing. Again, not increasing prices necessarily, but making changes to your pricing once every 3 months. And I know some of you are like, I can't make changes. Well, it's like, well, if your product, your brand, everything's improving, then your monetization should improve as well. And the cycle that we normally recommend is basically like a quarterly process. The committee will meet in the first week, and then you have like a marketing manager or product manager where 20% of his or her job is going off and doing the research. In the third or fourth week of the quarter, they'll bring it back to the pricing committee, and then they'll make a decision, or maybe they need more data. The person goes off, brings back more data. And then depending on the gravity of the change, like if you're just adjusting a discount strategy, you don't really need a communication plan or an impact analysis or anything like that. Whereas if you're raising prices by 50%, you probably want to go through a very starch communication plan, an advisory panel, these types of things, and then ultimately, obviously, implementing the changes and tracking them. Now, who should be involved here? Products, marketing, that's where pricing should probably sit. So the final decision maker, if it's not the CEO, should probably be the head of product or the head of marketing. Sales and finance needs to be involved in the conversation because they provide really valuable information, but also like if you come to your salesperson and you're like, great, we've been working on pricing for 13 weeks. We're now going to implement this. Your salesperson, not all of them, but a lot of them are going to basically just like, politic and basically be like, nope, not going to happen. And then it's going to delay it for 6 weeks. It's not their fault. It's just they have to be the ones to probably push this forward. And it's one of those things where you want to involve them early on, not only so that they can get on board quicker, but also because they have valuable information to provide. Finance, if you're a larger company, your corp dev kind of team can handle this. But if you're kind of I would say sub 75 million, your finance team, I'd be careful with giving it to them. Finance is typically very, very good at Excel engineering pricing changes, but their inputs aren't necessarily as good. And so marketing and product, they should theoretically be closer to the customer, and they should be doing some form of customer development already. But the big thing to keep in mind here is like your committee, like HubSpot's pricing committee, it looks like the United Nations. It's huge. There's so many people on it. It's probably not entirely effective. But the big thing to kind of keep in mind, and I know this sounds super simple, but deadlines and decision makers. Pricing is one of those things where it's like everyone's a little sensitive about it for good reasons, but it's like have a deadline, have a decision maker. And I would recommend making sure you start small with something. Don't start with something big. Don't start with like, hey, let's fix our pricing strategy. That's way too broad. I would start with, let's figure out our value metric. That's a little bit of a bigger question, but it's an important one. Or, hey, let's do localization. The reason I like localization as a good starter project is it forces you to get your billing system in order. It forces you to, basically have a pretty easy thing to research because you're going to keep your product basically the same across the different regions. The only thing you're going to change is your price and maybe your value proposition. But ultimately, it helps kind of push things forward.
Yeah, on localization, there is a question actually in the Q&A here. And because I think 100% of the people connected here have that problem because we all have a footprint on one side of the Atlantic and another footprint on the other side. What I have seen historically, right, we're scratching our heads and we're like, okay, I'm going to convert €1 to $1. And then at least in the enterprise software space, what I've seen is that we were not extracting enough value. The customer, the personas, they were willing to pay more. And I see a lot of examples right now of people I'm either on the board of or talking with where they're able to almost double the price on the enterprise side, right? And this varies a lot between the US and Europe. One of the questions was like, hey, can you show again that graph? It seems like for you, on average, you see the ability to extract more in Europe than in the US because your baseline was on the US. Just walk us through again real quick to that chart.
So right now, and again, this is an aggregation of a lot of different products, just to be super clear. But when push comes to shove, in general, the willingness to pay in the UK and Western Europe, especially the Nordics, is actually higher. Now, Eastern Europe is lower, but the reason for this, or at least the reasons that we've seen, typically the competition subset isn't as extreme in Europe as it is in the US. And in addition to that, like Europe, it's really kind of funny. Like European sales are typically very relationship based. It's just like, the UK, the old adage is like, we don't do business until we go to the pub, right? Whereas US, it's like, I don't want to talk to anybody. I'm going to sign up and I'm going to figure it out, right? And there's those people on both sides of the pond that are, very similar as well. I agree with
that broad statement, yeah. Mm-hmm.
Yeah, and so it's one of those things where what we've typically seen is that because of the relationship focus, and this is I'm extrapolating a bit too much than I'm comfortable for, but I think it's an okay extrapolation, is that a lot of times like the willingness to pay then goes higher because there is such a relationship baked into it. Mm-hmm. Now, in some regions, France, there are some interesting tax laws depending on the product that you have. Brazil, there's crazy taxes that make it insane for anyone to work or sell into Brazil unless there's like a huge market for you. But it is one of those things where we typically do see. And then in the Nordics, we've seen it's just the cost and standard of living is just higher. And so like the idea of like how much things are like, it's just much higher. So people are willing to pay more.
I've seen that in Australia as well. And I think here the point is not to say, hey, you should price 20% higher in Europe than in the US. The point is to say there are major variations and every business should look at the value drivers and open their horizon in decoupling the pricing between their local domestic market where they had the great product market fit and the US, for example. And I think also it's probably a huge difference between a US product that you sell in Europe that has that quality because software is known, right? I mean, clearly the US is known for the hotbed of software. when you talk about France, we're known for the 3 Fs, like food, fashion, fragrance, right? And you take great food, great fashion, great fragrance, and you sell it more in the US. And the reality is, if you go a Louis V bag or a Longchamp bag, is double the price in the US than you can find it in Paris, for example. So that's also the difference between, I think there is a component there of taking a product that is well known in the US and exporting it into Europe is not the same as taking a European software product and bringing it to the US. So that all needs to be taken into account. It has some questions there. There was a great question from Kevin about the multi-access pricing. We love to do that in Europe. We have I'm selling you a set of product features and you have bundles for that, and then plus the number of users, plus the usage. I went through that at length at Adobe. We had 500 SKUs, etc. And Adobe was like, no, you give me one pricing metric. So what's your thoughts on that?
So I think you have to be careful because the number of axes that you can use is dependent on the sophistication of your buyer and the sophistication of the sale. So what I mean by that is, if you're selling to SMB sales or marketing people and you have 4 axes, it's not going to work out well. It's just not going to work out well. Whereas if you sell to an SMB that has an engineer and you're selling to the engineer, you can sell AWS with 16 different axes, right? So I think it's one of those things where it is a little bit of a sliding scale. I think that most of the time what you should be doing is taking your axes and finding a proxy for those axes. So for example, oftentimes the number of contacts is a proxy for the number of users who are going to be in the account, the number of amount of usage that there's going to be, and so on and so forth. And so what I'm a big fan of is having a primary axis, a primary value metric, and then only using secondary, tertiary, quaternary value metrics for backstops. So what I mean by that is HubSpot right now, they price based on contacts. And then basically when they put only a user limit on the lowest tier. So if you are basically a company that needs more than 4 users, I think you automatically have to be on the middle tier or the higher tier. And the reason for that is because there are folks who have a low number of contacts but high value contacts, and so they want those folks to be moved up. And so that's kind of my take on this. I think that a lot of times people end up overcomplicating things. And if you're in an enterprise sale, you can certainly overcomplicate things if you want, because there's a lot more FaceTime that's happening and negotiation. But I would be really careful with too many axes. I think what happened is we went from good, better, best pricing, which was okay advice, but really simple advice, to, hey, now we can charge based on 20 different things if we wanted. And really we need to find kind of a balance in between, if that makes sense.
Yep. Yeah, that makes total sense. Of course, I've lived that personally, and especially when you then have a sales force that's worldwide, the ability for that sales team to consume your pricing changes and get enabled on the pricing changes is a huge factor also in adjusting the pricing and making it super, super simple. Because we had, salespeople, once I joined Adobe, we had salespeople selling my product, but also some other products, even if we also had a specialist always coming in. But those price conversations were critical. And it drives the sales velocity in a SaaS business, having additional objections, trying to find the number of users that are going to use it, having to go back into the organization saying, oh, by the way, how many contacts, how many users, and the features, and this and that. The more people you involve, the less velocity you have in the sales cycles, right? So that's another thing to consider. This has been where over time here, Patrick, this has been super, super insightful, especially also in light of the crisis that is going on. So I would like to really thank you from the bottom of my heart for sharing that. And also we have your contact information there so that we can, the people can reach out to you and ask you for a contact, ask you for the connection into your live, almost live daily analysis that you're going to do on how the SaaS businesses are going through the current COVID-19 storm. That's going to be super great.
Yeah, and I'm putting this up here. Feel free to email me. I know it says free pricing on it. This is our CTA for our webinars and stuff. I'm more than happy to give you a free pricing audit. We we're all about like giving a bunch of information and just being like, hey, this is where you are in terms of your ARPU, and here's like where you should be based on the rest of your market, or maybe you're great and you should focus on these other things. But I'm also providing my email here. Like if you want to get on the index, or if you have any other questions, like I was telling, the folks before the call, like if we have so much data, if you have a question on discounts, you have a question on annual upgrades, you have a question on all these different things, we have some data on it. And if not, like we know where to get it. So like, feel free to email us. I'm more than happy to help. We're big believers in just like giving back to the community, because, we find it comes back to us, tenfold. So yeah, just let us know if you have any questions.
Yeah. And last but not least, of course, I didn't mention, but Patrick is a huge Francophile. He spends most of his vacation in France, also knows a number of regions inside out. So, that's the cherry on the cake.
But
so
very little French. I know very little French.
No need for that. So thank you for that as well, and thank you for today, Sacha. Did you wanna close it out there?
You tell everything. So just thank you from everyone. I just read. Thank you, Patrick. Thank you for the super helpful insights. Everything. So just thank you to you. Patrick, thank you very much, Stefan, also to drive this SaaS Club with French founders. To everyone, be safe. We have to continue the business, and talk to you soon.
We'll have to do an update on that in like 3 months or so, Patrick, because it's going to be like super exciting to do a follow-on where we look at the curve, right? Where is it going? The B2B, the B2C SaaS, the metrics that you're measuring, that health of the overall SaaS flywheel out there with all your data points. It's going to be super exciting to do a follow-on on that. And we still have 40 people connected. So people even over time, they wanted to hear more. So thanks a lot, Patrick. Talk to you soon. Stay all safe and healthy. Take care.
I'll see everybody.
Bye now.
Bye.